Disney reportedly forming a new task force to study the application of artificial intelligence across the company amid the ongoing Hollywood writers and actors strikes. The news coming a day before Disney is set to report third quarter earnings. Joining me now to discuss is New York Times columnist and CNBC contributor Jim Stewart. Jim, always good to have you join. Look, I suppose every big company probably has a task force to figure out if AI can help them in some way or another. With Disney, though, it does seem to fit with a picture of a company that's, looking for efficiencies any way they can find it to try to restore the economics of all these business models that are challenged. It's, content creation, movies, and linear TV. What's your take?
Well, the timing of this announcement is especially bad for Disney, given that the use of AI is a huge issue in the ongoing, negotiations with the writers and to some extent the actors. They just started talking again, and this is going to inflame a lot of the writers. So let's face it, it's their necks on the chopping block here. AI does have the potential, certainly, to reduce some very large costs for Disney. Not just Disney, but all the Hollywood producers. The costs, Wall Street has been very concerned that the costs of these streaming services have just been skyrocketing and are out of control. And AI is certainly a possible way of sharply reducing those costs. I mean, when you really look at what Disney and a lot of these other studios produce, it's pretty formulaic in many cases. There are set elements, and particularly the action-adventure genre, the sci-fi, the Marvel things. There are set pieces in every one of these, and dare I say it, AI could probably write some of that. Now, that said, the high concept issues, the truly original work, that's got to come from humans.
Right, especially at a time when, in theory, the kind of cookie-cutter formulaic, film release slates are one of the things that's wrong with the franchises that used to be so profitable for Disney. I mean, just big picture for the company, though, they're in a fix, as other media companies are, where the areas that are growing fast, like streaming, are not profitable. They're basically burning up capital. The places that have cash flow still, like cable TV, are shrinking pretty fast. It's created a situation where CEO Bob Iger has said we have to consider all options, selling a stake or finding partners for ESPN, maybe selling out of broadcast TV. Where does that place the company that used to be one of those deals that said, look, when the stock goes down, it's a great franchise, it's the best brands, just buy it? Seems like the equation's changing.
Well, this has really been a pivotal sea change, certainly for Disney, for the entertainment sector generally, but maybe Disney more than anyone. I mean, the stock is now near its 52-week low. The expectations are so grim for the earnings that I suppose that the only real surprise would be maybe better than expected, but they're getting hit on every single front. And certainly the decline of linear broadcasting, the cable channels, the old broadcast networks, this is a serious issue, especially for Disney, but for all of these companies. I mean, I think it came as a shock to a lot of people when Iger went on, this very network and said, I'm putting everything up for sale. This isn't core anymore to Disney. And that came to a shock for both people inside the company and outside the company. But I think people were looking like, what are the trends that led him to make such a drastic statement? I mean, they're really declining. And then secondly, if that's true, who's going to want these assets and at what price can they unload them? Again, it seems like if there were obvious buyers or people lining up to buy these things, Iger wouldn't have had to advertise that they're going to be for sale.